Hi, everybody. It's Greg Schnell, and I am here with the 2020 reflections, look back at the year, and then to look forward. And the way we're going to look back is through the charts, but I want to show what I see as setting up to be a pretty exciting 2021, and hopefully I can share that with you. First of all, the backdrop would be that the vaccinations work, and we do get a big speed up in the world economy. I think the Fed is actually expecting a 4.2% GDP growth, which would be faster than anything we had in the last 4 or 5 years. So a massive acceleration in growth, and I think commodities are going to be a big part of that. So, one of the things we need to talk about when we look at the charts historically is how do they change over time, and how can you start to see a new bull market? So, I want to show you the charts that I see, and I think you'll agree, hopefully by the end of the show. You'll agree with what I'm seeing in the big picture. I want to use different methods, not just the commodities charts, but I also want to see changes in other asset classes like currencies and global stock markets to show the commodities breakouts. And again, there's a couple of chart shapes that are already starting to have multi-year breakouts, so those are pretty important. I use the PPO as my momentum indicator, and the main reason I want to share that is a lot of times the PPO can give you clues about where we are, and I want to use that type of information to help us. And then lastly, I'm going to put up some fundamental data, inventory data, that kind of stuff. But it's still in chart form, but I think more importantly from that data, we can gather some good ideas going forward. So let's talk about the CRB. The Commodities Research Bureau Index is actually made up of 19 commodities, but the biggest weighting in that is the energy sector, but also metals and minerals play quite a large role. So we had, this is a 40-year chart, 1981 to 2021. What we see on this chart is a massive, we had a big decline in commodities all through the post boom of the 1980s, and then coming into early 2000 it started to take off, and so we just kind of kept working our way lower, which was fine. And what we saw in the PPO here was that momentum was just hugging around the zero line and would briefly go above zero. And for this run in here, we actually got a nice 3-year move out of it. That was great. And then it declined for a few years and then ran and then declined. But what happened here when we started the 2002 thrust was we actually got our highest momentum indicator in 10 years. And then as we got that, we fell below we stayed above zero, and as we stayed above zero we had a big run, and then we went below briefly, and as we went below we popped back up and we went on a big run, and we had a really supersized move, and then it all came tumbling down during the great financial crisis. Since then, commodities have been in a big decline going on 13 years now, from the high in oil in 2008. And what we see is we have a big downtrend in momentum, but we also have the highest momentum reading starting in almost 10 years. And the second component of that is we've broken the downtrend. Everything is syncing up to be quite a big, meaningful place. On the actual CRB chart, we broke out in 2019 above the downtrend line, fell down with COVID, and are now starting to work our way back. So I actually believe that the commodity market was trying to break out in 2019, fell down, and it is now restarting, and we're right at resistance now. So some people would say, oh, just get out and leave it. I actually think it's this PPO clue and some of the other charts that I'll show you that lead me to believe that this is just the start of the biggest bull run you've ever seen. So some commodity breakouts have already happened. We've seen some in gold, copper, and soybeans. And again, when we look back and reflect on 2020, that's what we see in those charts. So here, 2019 for gold, we actually broke out in May of 2019 through a 5-year base, and we ran all the way up. We made higher highs in gold, and now gold topped out roughly August of 2020 and has pulled back for 4 or 5 months. And we can see the PPO momentum is getting back near zero. If we're actually going to maintain our big bull market, this should start to turn up about now. and we should start to see another run in gold and gold miners. When we look at copper, copper recently, like in the last 2 or 3 weeks, just broke out to new 7-year highs. This is huge. Copper is a really big global metal, and what happens in copper could typically help us define global growth. But more importantly is what we see on the copper. It's quite interesting to see the PPO. When we were in our big bull market, we spent a lot of time with the PPO momentum indicator above zero. And then for 6 years, we spent, the PPO indicator was below zero, had a 2-year run up. And then when the trade tariff talks started, we pulled back for 2 years. And again, we were just starting to break this downtrend here in 2019, fell over, and now we've broken out to the upside. But the PPO is giving us a clue. It's at the highest level going back 10 years. I think that's a clue that this is also breaking out to new multi-years, and the trend is just starting. So soybean, just to pick some different type of commodity, an agricultural commodity, what we see is a big decline from 2012. So oil topped in 2008, metals topped in 2011, 2012, and soybeans topped in 2012 as well. And then, so these big downtrends, and now it's starting to break out to the upside, and it's been a big run here. They've gone on a great run. Now, when I look at this chart, it has these sudden spikes and then pulls back. So it's right at resistance. We'll wait and see how soybeans respond. But I still think we've got a lot of people to feed on this planet, and we'll find out if soybeans can keep up. So confirming the commodity breakouts, we also want to see currencies and commodity countries break out. So how does that look? Well, here's the CRB index again. This is the same chart I showed before, but I put the US dollar on the bottom. And the reason I did that was commodities, when the dollar topped out, commodities were bottoming out, and they started to turn up as the dollar was falling apart. They don't match day for day, but in the big picture, you start to see these changes, and that's pretty important to be aware of. And then, quite frankly, the dollar and commodities chopped around through the early 90s together. The US dollar went on a big run with the technology thrust from 95 to 2000, and commodities were kind of the unappreciated friend. And then, all of a sudden, as the US dollar broke down, commodities broke out, and then US dollar tried to rally, commodities pulled back, and then the US dollar went on its final push down to the bottom to make its lows in 2008. Well, oil made its 2008 top. Oil in 2008 was very frothy, lots of things going on. But more importantly, what we saw was everybody moving into commodities, so there were projects, and there was money being thrown at it. That situation, high commodity prices drives that, and then when you have low commodity prices, you get the opposite. So we want to watch for that. So now we have a big downtrend in commodities, tried to break out in 2019, fell back and started to break out again. That's this little bump here. We're right up against the bottom of resistance. But the big change that we've seen now is that the US dollar has also broken. 2008 was the low. 2011 was the last time the line touched. But this break in this 13-year trend in commodity, or in the US dollar, I think is huge and is a big confirmation for the expectation for higher commodities. So when we go look at the Canadian stock market, it's a big commodity supplier to the world, one of the largest countries in the world. It's got lots of land to work with. What we see is that the Canadian stock market ran up while the commodities ran up. Pullback, commodities ran up, and the dollar ran up, stock market ran up. And then we hit so this was the oil high, the metal high, and then what happened was then oil collapsed in 2014, so the Canadian dollar went down with it. And we see the same thing up here, the Canadian stock market. And for the most part, even in 2018-19, we weren't going anywhere, just kind of meandering along barely above the 2008 highs. And then all of a sudden, we finally broke out in the fall of 2019 as the Phase 1 trade tariff tennis deal started. So that started to happen, COVID hit, and now we're actually breaking out back above that level again, just starting to do that now. So again, I think this is another sign that the commodity bear market is ending and we're actually getting ready to break out to new highs. What we see here in 2013 was the Canadian dollar went on a big drop, and we're just starting to break this horizontal support and resistance level. This is where we stopped in 2009 on the way down, and as the commodities started to kick up in 2003, 2004, that's where this trend line created. We just had this now. I think we've got a nice double bottom in place here, and we're starting to move higher, but we've broken through this resistance line. Pretty important, I think. So here's the Australia situation, and I can go back through the whole history of the chart, but the point I want to make is Australia topped out with the price in oil just before the price in oil in 2007, kind of with the US stock market, pulled back, and it literally till 2019 had not made it back through the 2007 highs. I want you to compare that to the U.S. market. It's crazy. U.S. market was at 1575 for its top, and it was over 3,000 recently. So it's been more than a double. What we see in the Australia currency was when metals and mining topped in 2011, 2012, and ag as well. All of a sudden, this all fell down. And now we're starting to see this break of this trend line. This broke when copper started to break through its base. And then as copper broke out, we now see the currency making higher lows and higher highs. It's now sitting well above this horizontal resistance. And we're seeing the Australia stock market breaking back through those prior highs. So again, as the commodity breakout started, then COVID hit, and now we've got this commodity trying to start again. So I think this all sets up quite nicely. When I look at Russia, the big thing I see on this chart, I've changed the time frame a little bit here. This is 2002, running all the way up. And then we got to the highs in oil in 2008, fell hard with the great financial crisis, rallied back up, made its highs in 2011. Does that sound familiar? That's the metals high. And then we fell down to 2016. This is also when copper bottomed. So we had lots of things, and oil hit $25 here. So we had lots of things bottoming in this area. And then Russia was slowly working its way out of the hole, started to break out the end of 2019. You've heard that story before. And pulled back due to COVID, and now is breaking out again. So it's broken through its horizontal resistance and looks like it's ready to go. So this is a major commodity supplier to Asia and Europe, and it's breaking out. So I think, just US dollar wise, Canada, Australia, Russia, when we go around the world, we're starting to see this trend emerge through a whole bunch of different charts. But one of the things that hasn't broken out is crude oil, and crude oil makes up one of the biggest percentages in the CRB. So how does that work, and how can we affect is crude oil done? And if you're on the movement towards electric vehicles, many people think crude oil is done. I am of a very different opinion. I think one of the things that's happened is we're almost at peak hysteria for autos, and we're not going to be anywhere near peak, but we're peak currently, and we've decided we're going to move to electric, which is really cool. But we need literally 22 new hydro dams per year for the next 15 years to get to a point where we could start to take internal combustion engines off the road, like California wants to do by 2035. None of those are on the books, and even more importantly, so it's going to be wind, solar, geothermal, hydrogen, lots of different sources. We have a whole 15-year run-up to get there, and crude oil is going to be a part of that to try and get us going. So oil charts are what we're going to cover off, and then I want to get into some of the demand and supply situations for oil. So here's crude oil, and you can see a big downtrend. And on this downtrend, again, we had a horizontal support and resistance layer. We're just starting to break above it. This is pretty meaningful. Oil trading at $48 as I present this. I thought it would get to 50 by Christmas or year end. It's not quite there, but let's call it rounding right now. I still think the high of the year was $65 for 2020. I fully expect us to get back to $65 in 2021. So that's another $20 higher from here. Meaningful levels of change, and I want to talk specifically about that. One of the things that we see, again, using the PPO, is that when oil is in an uptrend, the PPO for the most part tries to stay above zero. It fell down in 2014, spent all that time below zero. This is a pretty bearish situation. Moved back up for a year, down for a bit, back up for a while. We're just starting to break out. We're making new 2-year highs here. And now what we want to see is, do we have enough energy to get back above that 2018 high? I actually do think we do. I think we get through that and we have lots of room to go to the upside. And the main reason for my thoughts on that is, as we come out of this post-COVID situation, when you look at the people in Wuhan, China, they're seeing more mobility than they've seen before. Lots of people getting out, entertaining with friends, traveling. They really want to get out and appreciate the ability to be mobile. So I fully expect that for the Western world, and I think that's actually going to accentuate the demand. So we already have increased demand in Asia, and I think with the pandemic, with the vaccines now, 2 of them have been approved. There's more coming. England got 130 or 120,000 people vaccinated in the first week. We're going to roll this out quite rapidly, and as more and more vaccines come available, I think Jim Cramer said J&J is one of the next ones, and they have lots of inventory. So as all of these vaccines come out, I actually think we're going to ramp up very quick. We're not waiting for one here. There's 1, 2, 3, 4, 5 vaccines coming at us. And as they come at us, the ability to stop the transmission will be key. And obviously, once we slow that, I think the economy starts to speed up very quickly. So here's crude oil with the US dollar. And again, crude oil goes on this huge run up and the US dollar is falling. The dollar makes its low, the commodity makes its high. In 2011, commodity makes its high, the dollar makes its low. 2013, 14, we come up and we try to take out the prior highs. Currency tries to take out the prior lows, can't get through, and all of a sudden it breaks out to the upside as crude falls. We come over to 2018. The dollar actually bottoms on the crude tariff, or on the tariff talks, but crude takes a little while longer. It doesn't really go. I guess it moved up $5 or something. So as crude moves up, it gets to $75 and then rolls down. In 2018, when everything did, then COVID hits and it falls again to zero overnight, and then took off from there. I think we've made the lows in oil, right, at zero. And then we see this big break in the trend line. So we see a direct correlation between the currency and the trend lines. In here, we were making lower highs on the dollar, higher lows on the commodity. And then when they all broke, they broke together. Like, there's a lot of similarities that go on between the two, not necessarily day to day, but in really big picture math. Okay, so the dollar's clearly breaking the 11-year uptrend from the 2008 lows, and crude oil hasn't quite moved yet. But this little move right here, caused oil stocks to move 50%, just to put this into perspective. So crude moved up $10, and the oil stocks literally shot up. And so I think as crude starts to get back to 65 and works its way higher, we're probably going to find some pretty big moves in these oil companies. And again, some of them fell 90%, some of them fell 50% and 70%, just a simple double to get back to where we were in March. And some of them can go a double to get back to where they were in January, another double. So really, a big compression in the oil just due to the sudden slowdown. Now, we were using about 105 million barrels a day and we dropped that down to 80. We're now back up into the mid 90s. All of that starts to suggest to me that this is about to go higher. So here's crude oil at 36, up 36% from the end of October. Big move. And here's XOP from that same time period, moving up 55%. Just big moves. So XOP is the Exploration and Production ETF. So now I want to cover off some of the inventory data because this is scaring everybody off. What we have is back in 2019, the peak oil inventory level got up to the level we're currently at. And the big thing, this is from 9 Point Energy Fund. And what I want to show on the chart, they put this graph together, but the data is from the U.S. Energy Information Department. We see this, crude was at 45, we're currently just above, crude was at 55, we're currently just above 45, but we're at different times of the year. The point I want to make is we've dropped dramatically from peak oil inventory, and yet we don't have any drilling to kind of pick up the activity. So once demand starts to ramp back up with the COVID vaccinations, I expect that this chart's going to be under pressure lower, and that's going to be one of the reasons that we help oil prices move higher. So again, in the short term, the high COVID counts could slow demand. That might be January. We'll just keep watching to see how it goes. Right now, crude has held up really well after breaking above the summer highs. It just seems very resilient here. When we look at traffic activity from TomTom GPS systems, what we see now is that traffic hasn't dropped anywhere near as much as it did in the March and May timeframe. So we're still seeing a lot more mobility, and I think with the lower oil production and the higher, with people coming back after COVID, that we could actually see a real acceleration in demand, and yet we don't have supply picking back up. So be ready for oil to start to decline post-COVID. That could be as soon as January, might be February, but it's that kind of time frame. One of the big things that's shown up, though, in this year is looking back in 2020, all of the majors have all stopped building major projects, and most of them have stopped building major projects. And each year we need to drill to make up for declining reservoirs. So again, the gas tank analogy is you've got a full tank of gas. Well, a reservoir is the same. It's got a full reservoir of oil. As you take oil out of that, there's no new oil coming in. So what you're declining. So each year you have to drill more wells to keep up with the decline rates in your reservoir. Shell has said they're not going to be focused on that side. They're going to focus on renewables. Same with BP, Total, Repsol. Exxon has still got some major projects going, but again, they're all getting the memo of trying to get rid of carbon. So they're all slowing down on these. So if you've got all the majors not participating in the next swing up, how's that going to work out? So Shell actually said that they probably peaked their production in 2019 and don't expect to break back through that high level. You know, when you go listen to BP and Total conference calls and that kind of stuff, Repsol out of Spain, they're all talking the same language. So they're clearly thinking that they don't want to spend money for the long term in oil. They're not going to build big 20-year projects because they just, you know, if the move to electric is going to go that way, then fine, they'll just get out of the way. In the meantime, that could leave us in a huge demand crunch here. So what we've got is, this is the number of mega projects by year. And in 2020, this was kind of the peak level. And then the next 5 years, because these projects started back in 2012, 2013, and then in 2014, everything fell apart. Well, lots of these projects take 5 years to build. So just to give you an idea, the natural gas LNG project at Kitimat, BC is $40 billion. That's the equivalent of 8 Tesla car plants being built just to transport natural gas from Canada to China. It'll move in 10 days. And that one project is literally 15 years in development. So you take the whole scale of how big these projects are, you can't just turn them on. So when everybody stopped because of the low price of oil in 2015, that's starting to show up now, 2021, 2022. What you can see is even over the next 3 years, we still had big decline rates. And the real question will be, can these projects come on because of the massive slowdowns we've had? And will they be able to keep up? So this is pretty important data. And many people think that the U.S. shale will just start to pick back up again. But they've drilled most of their Tier 1 and Tier 2 reservoirs. And what this shows is the growth in shale. And while it's still growing, it's very marginal. And I've seen lots of charts that suggest it's actually not even going to grow. So Exxon still wants to spend some money in the shale plays, but for the most part, you're just finding a big reluctance for oil companies to put money into these mega projects. So we have a dramatic drop in the level of activity in terms of replacing existing decline rates, let alone growing the business. And then we're about to go through this jump in demand as people start to appreciate their freedom and get back out on the road. So I actually think this crossing point is going to come much faster. It's not going to be like a stoplight. It's going to be like a roundabout where more demand is entering and not enough is coming out. And so all of a sudden, we've got this hysteria that starts to build. So this is the price of oil before. And what we see is it was up around $100, fell hard, and in 2016 got down to $25, then ran back up to $60. And then fell back down, and we've had the big COVID slump now, and we're just coming out of the hole. I think we're kind of living through this part of the curve, and we're on our way up here. The big issue is the majors aren't participating, and they don't have a lot of inventory of big mega projects that we're still due to come on. So we have lots of issues in terms of replacing existing demand. Jet fuel wasn't that big a deal. It's already coming back to 60 or 70%. So we have lots of reasons to start to think about this. So demand will grow post-COVID, but production growth will be too slow to meet it. So that's one of the big nuggets that I think makes oil area a very exciting area. I expect growth to expand as COVID slows, but the drilling, they can't get the money in the juniors, and the majors don't want to drill. So this is going to be a really interesting crossroads. And again, we don't have enough to meet the ramp up in demand. So we do have large global inventories, but I don't think that lasts very long. So this is a chart from my good friend Tom McClellan. And what you see here is a big base building in gold and then a breakout. What we're seeing in oil with a 20-month shift is the two kind of follow each other. And we're expecting this break to start relatively early in January and take off to the upside. I get pretty excited about it. So demand for other commodities are about to soar. I've got a whole bunch of presentations out there about copper, steel. I'm going to do more on hydrogen, but wind power, solar. There's lots of things going on, and all of that needs a huge commodity input factor, and there's not enough current supply to meet it. So I think commodities across the board start to ramp up. So if you'd like for more big ideas on commodities in the year ahead, I used to do the commodities countdown. I'm kind of focused on this stuff. Anyway, I've got two offerings, an electric vehicle newsletter and a gold membership with a full market view. You can find those over at gregschnell.com. Thanks for taking the time to join me. Have a great 2021, and we look forward to having the pandemic behind us. Thanks, everybody. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.